So in this part, we are going to talk about liabilities. As I said before, liabilities are something that you owe to your vendors or your creditors, something that the business has to pay off at any date in the future. So again, there are two types of liabilities: the current liabilities that are due probably within the year, and the non-current or long-term liabilities are due beyond 1 year. So current liabilities, we have accounts payable. Accounts payable are usually associated when you are purchasing something from your vendors or suppliers. Short-term notes payable, that's basically a money that you are borrowing from your creditors or from bank or anybody who's giving you money and charging some interest on it. It could be 3 months, 6 months, 7 months, 8 months. It could be any number of current maturities of the long-term debt. For example, you owe a long-term debt, but part of the debt is due within the next 12 months. So that would also become part of the current liability. So anything due within the next 12 months. So when usually people say, what does it mean in the next 10 months? So you start your year on January 1st. So anything that is due. So for example, we started this year on January 1st, 2021. So anything that is due up to a point of December 31st would be considered a current liability. For example, the part of we are talking about current maturities of long-term debt. Suppose it's due on December 30th or December 31st. On January 1st, it would be considered no more the long-term liability. It would be considered a current liability because it is due within the same year. What are accrued liabilities? Accrued liabilities are the liabilities, the services, the products that you have used, but you have not paid it yet. For example, the last paycheck that you received from your company was on December 26, but you also work on December 27, December 28, 29, 30, and 31st of 2020. You are not going to get paid on December 31st. You will get your next paycheck around January 10 or January 12. So when you are receiving a paycheck in January 21, the 5 days that you have, or 4 days, 5 days you have worked in 2020, it's a part of 2020. So as we said, according to the matching principle, the expense should match the revenue of the period. So we are going to match those expenses. We're going to say that we are bringing this expense from the last year, but we are paying in 2021, but this expense belong to the income state of 2020. Okay? Just like a customer purchased something from you on December 30th or December 31st, but he is going to pay you in January 15th. So that revenue belongs to 2020, not 2021. So that's what we need to keep in mind. Unearned revenues, for example, you receive cash in advance on January 25th. On December 25th, and you have to provide a service or a product on January 5th. So for the 10 days you're having the cash, that cash is not your revenue. This is a unearned revenue because you haven't provided the service or the product that you have promised to the customer. But the customer, since giving you the money in advance, though, that will be considered an unearned revenue. And an unearned revenue, it's a liability because you as a business is liable to provide the customer the product or service at a later date. Now, non-current liabilities. Non-current liabilities are obligation that does not expect to satisfy within the same year. So today, for example, on January 1st, you are deciding what are your current liabilities and long-term liabilities. Something is due in February 2022. So on January 1st, you will classify that note or that payment that is due on February 2022 would be as long-term. But when you are making the same balance sheet on January 1st, 2022, that liability was not longer anymore a long-term liability because due in next month. So it will become a short-term liability or a current liability. Okay. they are not liquidated using current asset or the creation of other current liabilities, whichever. Examples include long-term notes payable, long-term portion of capital lease obligation, bonds payable, and pension obligation. So long-term notes payable, simple, you borrow the money and you have signed a note and you have to pay interest on it. Long-term portion of capital lease obligation, we discuss in financial accounting, there are two kinds of lease: operating leases and capital leases. Operating leases are basically like rent agreements and they are outright an expense, but capital leases stay on your balance sheet, and whatever payments that you are making, it's a portion of that payment become a current liability or a long-term liability. So you have to divide the current liabilities due in the same year, and the long-term remaining part of the liability is due over the year. So it's part of the long term. Bonds payable is the same thing, because we discussed bonds in financial accounting 2301, that the bonds are usually 5, 10, 15, 20 years long, and their principal is due at the time of maturity, but there is interest payment due every 6 months, every year, or every quarter, or every month. So those interest payments are part of the current liabilities, but their principal is not part of the current liability. Pension obligations that company is going to pay after the retirement, these pension obligations are usually long-term assets. Okay. The next part is we are bringing our property, plant, and equipment, because we are going to discuss depreciation. So I want to let you know one thing. So when we are talking about asset has a sort of a life cycle. So you purchase asset, that one thing, right? So you purchase a house. So house is an asset, right? So you purchase, that's the first thing. Then you do renovation, right? Some renovate and also do maintenance for the house. So renovation is considered capital expenditure. We discussed this in financial accounting. Maintenance is a ordinary expense. This is expenditure, and this is ordinary expense. When we call it ordinary expense, we right away put them report into the income statement. These capital expenditures, since it increases the value of the assets, so we add them on top of the assets. So for example, you purchase a house for $300,000. Then you have a renovation where you do put $100,000 swimming pool. So now your house is not 300,000, it's become a 400,000. So that's the one time when you change the historical cost of an asset, when you improve the asset, when you increase or improve the capacity and capability of the asset. That's what called capital expenditure. The next thing, what you do after that, you dispose of. So because every asset has a life, so after its life is over, then it's disposed. When we dispose, we either going to have a gain or we going to have a loss. While we are using, so in that from purchase to dispose, we use. When we use, whatever little we have used is become, every asset that has been used is become an expense. So for example, let's take an example of water bottle. A water bottle which is sealed cap is an asset, right? You bought it for say $2. If somebody wants to buy from you, they can give you $2 and they can get the bottle. But if you open the seal cap and drink half of it, means you have drank $1 worth of water, which you cannot take it back. You cannot bring it back, right? So what's going to happen, that $1 of water that you have already drank is now an expense, and that will become a depreciation expense, which means the water bottle, which was an asset, now has been used. So that used part become an expense, and the half bottle that remaining is still an asset, because at a later point you can quench your thirst. So that's the idea. And when we use, we call depreciation. And then on the next page, we're going to talk about depreciation in detail. All right. So here on this page, we talked about the examples of the long-lived tangible assets: land, buildings, equipment, furniture, fixtures, airplanes, machines, All of those things that have a lies greater than. And another thing that I would land, always remember, never depreciates, because there will be a question in the exam. All right. And then automobiles is another asset. Plant assets differ from other assets because plant assets are long-term, lasting several years. For example, if you purchase a truck, let's say F-150 truck for your business, it can easily last 5 to 6 years, right? The cost of plant asset is allocated to an expense over the year that asset is expected to be used, which is basically in depreciation. The allocation of plant asset over its useful life is called a depreciation and follows the matching principle, because that truck in the business is helping you generate cash revenue. So we need to match. So for example, if you want to know, suppose your A in this grade is revenue. So what is the expense that matches? So one of the expenses that you pay the tuition, another expense that you purchase the book, another expense is that you spend your time in doing the assignments for this course. So these are the expense that you can match. You can tell that, you know, in order to earn a grade, I had to enroll in the course, pay the tuition, I purchased the book, and I spent time learning the material. All right. A plant asset is recorded historical cost, the amount you paid for the asset. Okay. And one more thing. So for example, if you are purchasing a machine and this machine is coming from California to Texas, right? So if you are paying for the machine, of course, machine has a price tag. Then you are paying for the shipping and delivery. Then you are paying for its installation. And then you may be paying for training your employees. So until this machine starts producing products and help you make a revenue, up to this point, everything will become a cost of the machine. So not only the price of the machine, but also include the sales tax you paid, the shipping, the delivery, the installation, and the training. Everything will become the cost. So for example, a machine that you're purchasing for $30,000, when you add all those expenses, become a $60,000 machine. So you are not going to put this machine at $30,000 on your balance sheet. You will going to put this machine at $60,000. Okay. The actual cost is the purchase price plus tax, commission, and other amounts paid to get the asset ready for its intended use. All right. So this is the cost that we are going to do. The next thing we're going to talk about land and land improvement. The cost of the land include the purchase price, the brokerage commission, the survey and legal fees. Delinquent property taxes means, suppose I am selling you a piece of land, 5 acres of land, but I didn't pay the last 5 years of property tax. So you maybe end up paying those taxes because you want to have a clean title. So therefore you will include you paying my part of the tax for the last five years of taxes. Title transfer fees and cost of clearing the land means if you want to build a nice apartment complex, you may want to grade the land, make sure that you can put the building on it. So all of those things goes into the land, because land and building will be two different accounts on you. So for example, all of those things cost you $300,000, that you're going to put $300,000. And if you cost you $4,500,000 to build the apartment complex, so you have two things. This will not get depreciated, but this would get depreciated. Okay. And the cost of land does not include, that could also be a question. This could also be a question in the exam. It's fencing, paving, sprinkler system, lighting, signs, sidewalks, planting trees. All of those things will not go over here. This is all part of the cost of land, which called land improvement. So all of those things are going into land improvement. So you're going to have land, then you're going to have land improvement, and you're going to have building. Always remember, land does not get depreciated, land improvement gets depreciated, and building get depreciated. So keep that in mind. Land and land improvement are two entirely separate assets, and land improvements are depreciated. All right. So when we are building our apartment complex, we have to pay the architecture fees. We have to get the permits from the local authorities. We have to give the money to the contractor, payments for material, labor, and miscellaneous. All of those things will go into building a new apartment complex. If you are purchasing an existing building, you have to